Benchmark, the voice of business. Presented by LMD.
On this edition of Benchmark, we are turning the spotlight onto Sri Lanka's banking sector, and here to share his perspective on a range of issues is Jonathan Allis, the Managing Director and CEO of Hatton National Bank. Up next, LMD columnist Hasitha Premaratna discusses market sentiment and investor confidence as Sri Lanka struggles to find its feet post 421. And in our final segment, Anshari Pereira, product lead of Frontier Research, assesses regulatory changes in the banking sector and their impact on capital raising activities. That's the lineup for Benchmark.
Hello and welcome to yet another edition of Benchmark. I'm Savitri Rodrigo. We are exploring the banking sector today, and discussing a range of issues with us is Jonathan Allis, the Managing Director and CEO of Hatton National Bank. And ahead of the program, discussing all these issues, including how the global economy is impacting local banks, how the impact of fintech and digitalization on the banking sector, and the implications of consolidation on the financial services industry will be up for discussion. Welcome, Jonathan. So good to have you in our studio once again.
Thanks very much for having me.
What is your overall assessment of Sri Lanka's banking sector the way it is right now?
The banking sector hitherto has been very strong. As the governor recently said in an interview, it's the lifeblood of the economy. It also is used as a pulse and as a benchmark for rating agencies, and based on their reviews, investors bringing their monies into Sri Lanka, and then that also flows into other shares in other industries as well. But more lately, we have seen certain pressures being exerted on the industry, mainly with the recent increase in NPLs. There are collection challenges that are being felt in the economy. And the banking industry must take note of this and take all the precautions required in order to arrest this situation and get their recovery processes going in order to get back to where they were, so that they can start doing business as usual.
How is the global economy impacting local banks?
So primarily we saw last year the strengthening of the dollar, the increase in the dollar interest rates impacting our exchange rate, and a significant depreciation that took place, particularly in the third and fourth quarter, exacerbated by our own internal issues like the October saga and a disproportionate amount of imports which outpace the exports. But what we are also hearing now is that there could be a reversal of these interest rates. So if the dollar interest rates come out reduced by, let's say, 50 to 100 basis points, given that most of us banks have borrowed in dollars, it will benefit us in terms of the revised pricing over the next 2-3 years.
Consumer banking is believed to be one of the most likely sectors to be disrupted by fintech. In fact, there needs to be a look at automation and consolidating operations to improve profitability, with digital transformation and disruption becoming commonplace. How has the development of the banking sector been impacted by fintech and digitalization?
I think it has been good for the industry, contrary to what some of us think that this is competition and stuff like that. I think we need them to work with us. So if I just take the two separately, let's say fintechs, startups are, companies and entrepreneurs that we must support. We must get them into our own incubators, into our own innovation centers. We must collaborate with them. We must look at funding them. We must actually have government funding and bank funding together to sort of promote them. There are enough of global case studies where banks have invested in fintechs. Banks have created their own fintechs. So it's not something that we see as competition. Instead, we are actually looking to bring in our own digital layers on top of our core banking solutions and look forward to them, plugging and playing their own products and working on revenue share models. So my message to all fintechs is that we would really like to work with you.
Now, there have been calls for industry consolidation as this would lead to the efficient use of the country's limited capital. What are the implications of consolidation for the financial services industry?
I think it's a good thing to do, to have bigger banks as, transaction sizes and some of the bigger companies are getting larger and their borrowing requirements are increasing. In addition, if we want to venture out, it's that much easier as a relatively bigger bank. It can get a little tight here also with a fairly flat economy growing at 3% or a little under. There may not be enough room for all of us to play, which might then create unnecessary competition, and therefore then the risk profile itself tends to change within the industry. While the opportunity remains strong, I think it requires a good framework with regulatory support, stakeholder support, meaning shareholders, the staff, union, management all need to get together. In other countries, it's probably more straightforward because you're allowed to retrench, downsize, reduce the number of branches in order to come up with the exact fit. Here it might not be that straightforward, so you need to know exactly what you're getting into before you actually venture into it. But I think it's a good thing for the country and the industry.
So we'll continue with this discussion, Jonathan, as we move into a commercial break. After the break, Jonathan Allis discusses his views on the banking sector's initiatives to promote sustainable finance and how the tax regime could be reformed to support the sector's performance. Do stay with us.
LMD is making waves, airwaves. The next big thing from Sri Lanka's pioneering business journal, LMD Podcast, now online. Listen to our articles on the go at www.lmd.lk. Select, play, listen. It's that simple.
$8,500 done. 1,500 go. Hoorah!
What on earth are you doing?
I'm making money.
You're crazy.
Crazy for money. 10,000 steps done. Who the man? I do it every single day. Show me the money.
So you run 10,000 steps every day, huh? You must be fit.
Some days I do 20,000. Hoorah!
Welcome back. You're with Benchmark, and we are discussing the banking sector with the Managing Director and CEO of Hatton National Bank, Jonathan Allis. Jonathan, as I was mentioning before, the CBSL requested all licensed commercial banks and the NBFI to reduce interest rates on lending products for SMEs to make funding more accessible to them. Does the banking sector have a role to play in improving SMEs' access to finance, in your view?
I think it always does, and we have been playing this role for the last century and 3 decades, I would say 130, because we have been predominantly an SME bank, now doing great corporate banking work and microfinance, and probably the premier personal banking, personal financial bank in the country as well. But SME is something that we have done continuously. We will continue to promote inclusivity. We will continue to promote financial literacy. We will help them build networks, give them confidence. But in addition, it requires, I would think they need to start building equity. They need to start, onboarding themselves to pay taxes. They need to start doing their accounts well. And then the government should start to discriminate. Those who are actually doing all of these, you can look at certain seed capital, private equity coming in order to strengthen some of these equity SMEs. So it's not only the private commercial banks. I think there's a role for the government banks to play, for the government to play with the increased taxes that we actually put in. If some of those can be allocated to SMEs in important industries, so that they could actually use that. Otherwise, for them to work on borrowed funds alone may not be sustainable in terms of their returns, may be somewhat reduced. But I think the time is right for the government, for banks to get together with other interested investors to drive the SME.
So the central bank recently launched the Roadmap for Sustainable Finance in Sri Lanka, which, besides giving direction for many other areas, also talks about promoting greener, climate-friendly and socially inclusive businesses. What is your take on sector initiatives to promote sustainable finance?
So about 2-3 years back, we signed a pledge, about 18 banks. That's as part of Phase 1 Sustainable Banking Initiative. Now we are moving on to Stage 2, which is looking at, enhancing our policies and procedures, looking at bringing in sustainable champions, etc. So recently, I think in Washington, we had Central Bank going and signing up with IFC on the Sustainable Banking Initiative, which we then launched at the Central Bank Auditorium somewhere on the middle of June. With that comes in a lot of value add in terms of green funding, in terms of recognizing climate change and therefore adjusting banks' behavior, the regulators' behavior, as well as customers' behavior in doing projects, doing business that is, conducive to the environment and to the people. So one is being greener, environmental friendly, adopting the environmental and social governance principles. But then the other important aspect for a country like Sri Lanka is the financial inclusion part of it, where you create sustainable businesses by helping the youth, promoting entrepreneurship, onboarding women businessmen, bringing them into the economy. Those are very important initiatives the country should pursue, and banks like HNB should play a key role in.
In your opinion, how could the tax regime be reformed to support the banking sector's performance?
I think it can be made efficient, very productive. Now, say we have all these other taxes like the VATs and the NBTs and stuff, because not everybody is registered as a taxpayer. But by and large, a bank is registered as a taxpayer. I would say just keep it simple. A bank pays only income tax, right? So whatever the tax you want to collect from the industry, you apply through the income tax. Keep it so simple. You will save millions in processing costs without having all these other unnecessary taxes for an industry that pays its taxes 100% accurately.
What regulations would you like to see in the new Banking Act to be implemented in 2020?
So basically what we would like to see there is already the banking industry is heavily regulated. There are a lot of compliance in place, which is a good thing, because at the end of the day, we are custodians of our shareholders' money, but more importantly, 90% of it is our depositors' money, which we are very responsible for. So it's imperative that central bank imposes the right controls on banks in order to make sure that they remain healthy and the system itself is strong, the banking sector. What we would like to see is probably strong board governance, management governance, stronger adoption of fit and proper, and then monitoring of it, making sure that boards are not micromanaging, and management vice versa not doing the board's job, and then active supervision by the regulator to make sure that these parameters and the segregations are maintained, and that we don't just limit governance to a policy manual or a paper, but we actually practice it. And in having the right people in the industry, whether at board level and at management level and at key management personnel, I think very important for the industry.
And so what is your overall outlook for the banking sector for the rest of the year?
I would think we in the banking sector need to ride this next year and a half very cautiously. We need to still remain relevant in terms of we need to support the economy. There are still areas in the economy, even post 21st April, that are doing well. There is business there, and not all sectors are affected. True, tourism and related industries have got affected, but we are seeing signs of revival, and that's a good thing. So hopefully the next month or two will be better than what it was before. Then we're looking forward to a good December, January season, and then hopefully normalcy next year, unlike when this type of tragedy hit other countries. But the other industries are sort of moving quite well, and we are keen to support them, grow our business as well while they grow, whilst looking after the NPLs as well as trying to improve our recovery strategies.
Thank you, Jonathan. It's always a pleasure. We look forward to seeing you again soon on Benchmark.
Thanks very much for having me.
So that was Jonathan Allis speaking to us about the banking sector. He's the Managing Director and CEO of Hatton National Bank. On the other side, we have Anushan Selvaraja with more.
LMD is making waves, airwaves. The next big thing from Sri Lanka's pioneering business journal. LMD podcast now online. Listen to our articles on the go at www.lmd.lk. Select, play, listen. It's that simple.
$8,500 done. 1,500 to go. Hoorah!
What on earth are you doing?
I'm making money.
You're crazy.
Crazy for money. 10,000 steps done. Who the man? I do it every single day. Show me the money.
So you run 10,000 steps every day, huh? You must be fit.
Some days I do 20,000. Hoorah!
Hello and welcome back to Benchmark. I'm Anushin Sarvaraja. Now for a closer look at the latest on the post. Joining me is market analyst and LMD columnist Hasita Premaratna. Welcome back to the show, Hasita. Now, just as usual, start off. Just tell us how the bourse is performing right now.
So the market has recovered in the last 2 to 3 weeks. We've seen from the levels that it fell earlier, it has actually picked up about almost 400 points, which is quite encouraging. And there have been increased buying both from foreign and the local side. Mainly the local buying has contributed, but we've also seen the foreign buying side coming in as well in selected counters, because obviously the market fell to levels below its normal valuation, and it became stocks became more attractive to accumulate. So there was very clear accumulation coming on one side. On the other side, we saw the central bank clearly giving the direction on the rate reductions as well, so that there will be no push at least to increase the rates. So that also gave people the confidence to come to the market and kind of play an active role in the market. So that way we've seen that the index has actually been picking up, and the trend has turned positive much faster than most expected.
Now the EPF is in the market at this point in time. Could you just, do you have an opinion on what sort of areas they would be investing in?
Yeah, I think they'll definitely look at the diversified and the banking sectors, and also selectively they'll start looking at some of the key counters that are trading under value. I think banking sector is trading below the value. There were a lot of speculation and a lot of rumors around the bad loans and the high-end non-performing loans in the banking sector that can have an impact, but that's hopefully be more short-term. So if EPF is taking a longer-term view, and if the bigger bankers in Sri Lanka are trading at 5-6 multiples of 5 to 6 times of price earnings ratio, definitely there might be opportunities to acquire for long-term value creation. So short-term you might still see some pressure, but long-term I think it will be good. So we saw EPF doing that, and some of the state funds also doing that, and that also has helped to improve the market momentum.
External shocks then, Hasita, what do you think we should watch out for, considering it's a bit of a volatile world right now?
Absolutely. I think what we've seen between China and US is a lot uncertain, because one day you see that there are sanctions coming, the other day you see there are no sanctions. So it's a world of volatility, and I think what investors are getting used to is to live in that environment and to take calculated risks and also take certain views and move on. So I think a lot of funds, especially the foreign investment funds, are going through this as a global problem. And when you look at the Sri Lankan situation, it's more of a smaller problem. So for them, they have started to chip in, especially with the situation we had after the Easter bombings, and the market depressing after that gave the valuation opportunities for foreign investors. So they came in selectively and started to pick up fundamentally sound counters at the attractive price level.
Thank you for joining us, Hasita.
Thank you.
That was market analyst and LMD columnist Hasita Premaratna. We'll be right back after a short commercial break. Stay tuned.
LMD is making waves, airwaves. The next big thing from Sri Lanka's pioneering business journal. LMD podcast now online. Listen to our articles on the go at www.lmd.lk. Select, play, listen. It's that simple.
Welcome back to the show. I'm Anushin Sarvaraja. Now we're going to stick with the banking sector, and joining me from Frontier Research is product lead Anshari Pereira, and she will go into a little bit more detail in terms of the regulations to come in for the banking sector and also how they will affect capital raising activities. Welcome back to the show, Anshari. Now, to start with, how do you see the banking sector's performance in the first quarter of this year?
So the banking sector was coming out of a rather challenging year in 2018. So some of the factors seem to persist in the first quarter of 2019 as well. So one of these was, of course, the rising NPLs or non-performing loans. This was at around 3.4% in 2018, and it increased to 4.2% in the first quarter of 2019. So in light of this, the banks also seem to be a bit more selective in their lending, and we saw the private sector credit growth also reducing gradually in the first few months of 2019. The year-on-year growth in private sector credit was at about 15% in January, and this gradually reduced to about 9% by May. So in terms of the overall profitability of the sector, this slowdown in credit growth also impacted the bottom lines of several banks, where it translated into the contraction in non-interest income at many of the banks. So overall, in the banking sector, net profits dropped by about 29% in the first quarter of 2019.
What about the regulatory environment, Anshari? What new regulations would be coming in, do you think?
So because of the sluggish economic growth that we saw, the central bank has been trying to push down lending rates in order to sort of push loan growth as well as spur economic growth through that. So the central bank introduced a deposit rate cap in April 2018, which is mainly linked to the treasury bill rate. So the intention in doing this is to bring down lending rates through this by about 200 basis points. This deposit rate cap is to be revised quarterly. So after it was implemented in April, it was again revised for the third quarter in July, and the deposit rate cap came down by about 171 basis points in July. So we saw banks also reducing the fixed deposit rates in line with this. But in terms of a fall in lending rates, if you look at the average weighted prime lending rate, which is based on the interest rates that commercial banks charge from their prime customers, this has gone down from April when the deposit rate cap was implemented by about more than 120 basis points. But if you look at the average weighted lending rate, which is the interest rate based on the overall all outstanding loans in the commercial banking sector, this hasn't changed much from its levels in April. Of course, at the same time, they are also very closely monitoring these portfolios of the banks and have said that if they are forced to, that they will sort of bring in a lending rate cap, maybe as a last resort.
So on those regulations then, Anshari, what does this mean for capital raising activities within the banking sector?
So in 2018 and in the first quarter of 2019, we saw a lot of banks sort of going through that with the capital raising activities. And we also saw some of the banks being impacted by the unfavorable equity market conditions that prevailed during that time. So after around the first quarter of 2019, we saw the banks cutting back on their plans to raise capital and sort of having a wait and see approach to see if the market conditions will turn around. But of course there are several banks which have thinner margins or thinner buffers compared to the minimum capital ratios, which will have to eventually raise this capital at least by 2020, also given the developments after the attacks, which is likely to result in erosion of their capital bases.
Thank you for joining us, Anshari.
Thank you.
That was Anshari Pereira, Product Lead from Frontier Research on the banking sector. Thank you for watching Benchmark, and we hope to see you again next time.